Welcome to the Economist in Your Ear podcast. In a world grappling with these massive economic shifts and, well, really accelerating technology, how exactly do nations transform raw ideas into commercial powerhouses? And maybe more importantly, what are the true costs and benefits when the state, takes a leading role? We're exploring a fascinating article from The Economist today. It really dives into China's state-led innovation model. It celebrates some pretty impressive results, definitely. But it also highlights what the authors are calling mounting costs. But there's a bigger picture here, isn't there?
Exactly. Yeah, well, The Economist gives us a compelling narrative. Our job today is really to go beyond those headlines. We want to unpack some of its assumptions, maybe bring in some additional data, some more analysis, and really try to understand the complexities of China's approach. Because, this isn't just about what China's doing in isolation. It's about what it means for the global economy, for innovation itself, especially when, frankly, other nations are also rethinking their own industrial strategies.
Okay, so let's unpack this whole system. We'll look at how China became such an innovation powerhouse seemingly so quickly, and maybe more importantly, put its methods into that global context. Is it really such an outlier today? China's state-led innovation engine, the innovation chain in action. So the article paints this really vivid picture of China's innovation chain. Ideas seem to flow from state labs to commercial products incredibly fast. It sounds almost like a super efficient conveyor belt, doesn't it? What does that actually look like on the ground?
It really is quite something. This system, it kicks off with pretty substantial grants for researchers. These are in state-backed labs, universities. Then you have government officials actively identifying promising ideas. They don't just wait. They then help these research teams establish companies, often right within these special local development zones. It's very structured, almost like an assembly line, getting research out there.
That's such a tight integration between research and, well, business. Can you give us some specific examples, something concrete to really bring this innovation chain to life for us?
Absolutely. Okay, consider fusion energy tech in Hefei. Now, this company was basically carved out of a nuclear research lab just 2 years ago. That's it. And they're already commercializing advanced plasma technology.
Wow, already? In 2 years?
Yeah. And get this, you can actually see security screening devices derived from that tech popping up in local metro stations right now.
Yeah.
Or take Theseus. That's a company in Chongqing making computer vision sensors. It started in 2019 as a group of scientists, got funding, got support from the district government. And by 2024, bam, they were a leading player. They're even partnering with state-owned China Mobile. So these aren't just lab curiosities. We're talking tangible products deployed fast.
That speed is just remarkable. Does this speed translate into a measurable lead globally? Or is it more about these individual success stories?
Well, the output metrics are pretty hard to ignore. China stayed #1 globally for PCT patent filings in 2024. We're talking 70,160 applications. And remember, PCT filings, those are international patents showing global intent.
Right, a huge number.
And they also extended their lead in the Nature Index research output in 2024. By 2025, you had 8 Chinese institutions in the global top 10 for research output. It shows not just activity, but a massive scale of scientific and tech output.
So where is this model having the biggest impact then? Which industries are really feeling this state push?
So it's led to pretty clear dominance in areas like electric vehicles, EVs, and lithium batteries, obviously. But we're also seeing this rapidly growing lead in newer fields like humanoid robots. And it just dramatically shortens development cycles. Think about Xiaomi.
The phone maker.
Exactly, the phone maker. They built a successful EV business in about 3 years. 3 years. And it's even helping entirely new industries pop up, like flying taxis. They're leveraging the expertise they already built in EVs and drones.
And you mentioned Hefei earlier. That city keeps coming up as a sort of template for this. It sounds like a success story, but are there risks if other cities just try to copy-paste the Hefei model?
Yeah, Hefei is definitely a strong example. They've really managed to fuse the scientific and business worlds all under state direction. The city government there, they actively invest in private companies. They build out supply chains. They basically act as this interface, right, between labs, universities, and the market. Their big 2020 investment, that 7 billion RMB into NIO, the EV maker, that became famous, sort of the template.
Right, the big bailout that paid off.
Exactly.
Yeah.
And they're tackling these specific tech bottlenecks, too, like building low-temperature dilution devices locally for the quantum industry, stuff they used to have to import. But the risk for other cities, it's replicating the how without maybe understanding the why or the timing. Hefei's success was selective, built on existing strengths, a blanket approach everywhere else. That could easily lead to waste and inefficiency. We'll touch on that more, too. Nuancing the narrative beyond mounting costs.
Okay, so let's talk about those mounting costs that The Economist highlights. They suggest this state-led model is, well, maybe a really expensive way to innovate. But how does this actually stack up globally? Is China truly such an outlier in doing this?
That's a really critical question, I think, because while it's true, China's state role has definitely expanded, the alternative scenario isn't some pure laissez-faire world anymore, right? No. If you look broader, the U.S. and the EU are also running very muscular industrial policies these days.
That's right.
I mean, the U.S. CHEPS and Science Act, that alone is $39 billion in factory incentives, plus loans, tax credits. Over $32.5 billion is already announced. And the EU, they adopted a new Clean Industrial Deal state aid framework in mid-2025, explicitly to boost clean tech capacity. So China isn't really an outlier in using the public balance sheet to push tech diffusion. It's maybe more about the specific way they do it and the scale.
That context is crucial, yeah. Okay, what about the point that private venture capital gets crowded out by all this state money? The article cites a pretty stark number. A 41% drop in private VC investment year on year in the first half of 2025. That sounds like crowding out.
Well, this is where it gets fascinating, actually, because while China's traditional VC cycle has cooled off, it seems to be getting rechanneled, not simply vanishing or being crowded out entirely. Beijing actually approved this new National VC Guidance Fund. It's huge, aiming to mobilize around 1 trillion RMB.
A trillion, wow.
Yeah, and it's specifically targeted at hard tech, deep tech like advanced materials, AI, semiconductors. Crucially, this fund has longer investment cycles, a higher tolerance for risk, and it's explicitly designed to crowd in social capital, to partner with it, not just replace it. So this really changes the funding mix for deep tech compared to, say, the 2020-23 period. It's a strategic shift.
Okay, strategic shift. But what about the debt? That number, the article mentions public debt, including those local government financing vehicles, hitting 124% of GDP. That sounds less like strategy and more like, well, a potential credit cliff, doesn't it?
The debt risks are definitely real, no question about that. But the policy narrative around it is also shifting. It's moving towards more asset-based management. So yes, augmented public debt is high around that 124% figure using IMF-based methods. But Beijing is, at the same time, really highlighting the public asset side of the balance sheet. Things like equity in state-owned enterprises, huge land holdings.
So balancing liabilities with assets.
Exactly. And they're running these debt swap programs, too, trying to reduce the immediate refinancing risks for local governments. So maybe we should see this less as a simple credit cliff waiting to happen and more like a really complex, high-stakes balance sheet reoptimization. It's financial maneuvering on a massive scale.
The Economist also mentioned productivity, suggesting a slowdown there. Is that a sign that this whole innovation conveyor belt might be stalling, or maybe just becoming less efficient despite all the money poured in?
Well, several big multilateral organizations do flag weaker. Total Factor Productivity Growth, TFP, is a medium-term issue for China. And TFP, just quickly for listeners, measures how efficiently you turn input like labor and capital into output.
Right, overall efficiency.
Yeah, but interestingly, even their own baseline forecasts assume China continues growing at 4 to 4.5%. And they assume this growth comes partly through policy upgrades, precisely in areas like making services more efficient, speeding up tech diffusion, but the very things China is targeting now. So the risk seems less about the direction of the policy being wrong and more about the execution. Can they actually implement these complex upgrades effectively across such a huge economy? That's the real challenge.
Okay, execution risk. And what about that overcapacity issue, especially in EVs? The article suggests most Chinese EV makers aren't actually profitable, leading to this thing called involution. Can you unpack involution a bit? Is it really that bad across the board?
Right, overcapacity pressures are definitely there, particularly in the auto sector. The competition is absolutely ferocious. And involution here, it basically means this intense internal competition that burns through resources, but doesn't necessarily lead to big leaps in innovation or profit. It's like everyone's running faster just to stay in the same place.
A race to the bottom almost.
Sort of, yeah. But the picture isn't uniformly bleak or loss-making. It's quite mixed, actually. Look at BYD. They posted a net profit of over 40 billion RMB in 2024. That's huge. Like Auto also stayed profitable in 2024. XPeng, yeah, they're still loss-making, but they narrowed those losses sharply in Q2 2025. Record deliveries, better margins. So yes, competition is intense, involution is a risk, but it's not a blanket story of unprofitability. Some companies are clearly navigating it, consolidating power even. 3. What to watch next? Practical filters for the future.
Okay, so if we step back from the critiques and the counterpoints for a moment, what are the key practical things we should actually be watching going forward? What indicators will tell us if these Chinese innovation policies are genuinely adapting and, well, working?
All right, looking ahead, I think the first big thing to watch is this shift from breakthroughs to bills paid. It's not just about fancy lab results anymore. You really need to track procurement contracts and the setting of technical standards. For example, the Ministry of Industry and Information Technology, MIIT, they're pushing new 2025 standards for EVs and batteries. Things like safety, prepping for solid-state batteries, megawatt charging.
And those standards pull investment.
Exactly. They tend to pull private money into developing compliant products. It forces the market to adopt the new tech, turning innovation into actual sales and usage. It creates the demand side.
That makes a lot of sense, translating the innovation into real market use. What else should be on our radar?
Second, keep a close eye on the diffusion capacity out in the provinces. The really big variable here is how well these inland, maybe less developed, governments can replicate that Hefei model without overshooting or wasting money. Remember, Hefei's success wasn't just about throwing money around. It involves selective timing, building a whole ecosystem.
So not just blind subsidies.
Definitely not. Expect those national guidance funds we talked about to co-invest alongside local money, but with much stricter milestones and targets. The aim should be more targeted, sustainable growth, not just building factories everywhere. Smart investment, not just more investment.
And for those super competitive sectors, like autos, what specific things should we look for there?
For autos, yeah, consolidation is the name of the game. Absolutely key. You're going to see the profit gap widen. Companies like BYD, Li Auto, they'll likely get structurally stronger, while others, well, they'll either manage to narrow their losses significantly or they'll just exit the market. It's shaking out.
And the trade tensions.
Right. With the EU tariffs on Chinese EVs, U.S. barriers, you'll likely see more localized strategies. Things like joint ventures in target markets, designing cars specifically for those markets rather than just trying to flood them with exports from China. The global strategy has to adapt.
Okay, last area, all the buzz around AI and robotics, it feels like there's so much hype. How do we separate that hype from, actual impact in China?
Yeah, AI and robotics. 2025 definitely shows both things. There's clear hype, especially around humanoids, let's be honest. But there are also genuine cost curves coming down. Inference prices. The cost of running AI models are falling. Domestic open source AI models are getting much better.
So real progress underneath the hype.
Exactly. Look for the near-term ROI, the return on investment, in areas like computer vision systems, warehouse logistics, maybe after-sales service bots, humanoids. They look amazing, but they're probably a slower burn for widespread commercial use. So use big announcements like from WAIC 2025, the World AI Conference. Use those as signal, sure, but the real proof. Watch for actual purchase orders, real deployments by cities or companies. That tells you where the impact and the cash flow really are. That's the reality check. Outro. So what does this all mean for you listening?
Well, the Economist article is right in that China's state-led innovation chain has produced some really standout firms. And yes, policy overreach, pushing too hard, can absolutely create inefficiencies and waste. But when you judge against today's global policy environment where lots of governments are intervening, China's approach starts to look less like a total outlier and maybe more like a particularly potent variant of mainstream industrial policy. Just one with unusually fast diffusion, getting tech into factories, into vehicles, into city services really quickly. It's a different flavor, maybe more integrated.
Yeah, so the key question maybe for the next few years, say 2025 to 2027, it isn't really can China invent. We know they can. It's how efficiently can they commercialize and scale those inventions without overbuilding, without creating unsustainable debt bubbles. And those early signals we discussed, the national guidance funds, procurement driving standards, trying to selectively replicate Hefei, they suggest policy is trying to move towards more efficiency. But like you said, managing the debt, ensuring companies are actually profitable, those remain the huge execution tests. It really makes you wonder, doesn't it? In this new era of global industrial policy everywhere, how much state direction is too much? And where does that true market-driven spark of innovation still thrive when the lines get so blurry? Thanks for listening. Follow us to stay updated with the latest insights on The Economist every day. And don't forget to like, comment, and share.